Now, GOVI. So this is the new one. This is the new one. So I switched from GOVT to now GOVI. And I have some data here we'll go over. Just to give people an overview of why I did this. So again, we're on X. We're just using the AI tool Grok. Let's do a quick overview. GOVI, which is the Invesco Equal Weight 0 to 30 Year Treasury ETF. This ETF tracks the ICE B of A laddered maturity U.S. Treasury Index, which includes U.S. Treasury securities with maturities ranging from 1 to 30 years. Unlike traditional market-weighted ETFs, GOVI uses an equal weight approach, which is what I want, meaning each maturity bucket, e.g. 1 year, 2 year, up to 30 year, gets roughly the same allocation. This aims to balance exposure across the yield curve. GOVT, the iShares U.S. Treasury Bond ETF. This ETF tracks the ICE U.S. Treasury Core Bond Index, offering broad exposure to U.S. Treasury securities with maturities of 1 year or more up to 30 years. It's market weighted, so not equally weighted, it's market weighted. So its holdings reflect the outstanding market value of Treasury securities. It's with a heavier tilt toward issues with large insurance, often shorter to intermediate maturities. So key differences, kind of what we just went over. GOVI equal weighted across maturities. This reduces concentration risk in any single part of the yield curve, but may lead to higher exposure to long-term bond-related relative to market cap weighted funds. GOVT market weighted, meaning it's more heavily influenced by the most issued treasuries, typically shorter to intermediate maturities. This aligns closely with the overall treasury market. So basically, because it's equally weighted, let's see, /GOVI. We'll do a comparison. Where's that tool? There it is. GOVT. Compare them. And holdings. Or not holdings. Where they at? Nope. Nope. Performance. Oh, it doesn't show me the holdings. What if I just look at GOVI? There we go. Okay, so the GOVI holdings, you see everything is on here. It's roughly around 3%. Roughly around 3%. At this top one here, short-term investment, government agency portfolio, institutional, whatever. But it's mostly at 3%. And if I look at the GOVT, the same thing, all the holdings, it will have, these percents go down a lot. So 5%, 3%, 2%, then 1.5%, 1%, 1%, less than 1%. Oh, then there's like a whole bunch of them. Less than 1%. The GOVI was just the 30 different maturities, and it was all equally weighted. Everything around 3%, where this is just, they add on a lot, so it's more market weighted. So it's like it says, equal weight versus market weight. But if you compare the charts, which I think is more interesting, that's what I like to do. I like to compare the charts. I can click this button, there we go. VT, compare that. Then we'll compare the longer duration one, like TLT. We'll compare TLH, which is a shorter one. We'll compare IEF, which is a shorter one. Compare IEI, which is a shorter one. Is there SHY, 1 to 3 years? Yeah, a lot of lines on this fucking chart. Really gonna fucking like weird people out. Let's see, let's make these colors a little different so they stand out. Purple, red. Good enough. Okay, so if you look at it on a 5-year chart, you see this whatever color this is, like tealish color line. This is the 1 to 3 year. This is the shortest term, so it has the lowest volatility. Look how much these drop the longer the maturities get. This orange one here is IEI. This is the 37 year. This reddish one here. Oops. No. It's not what I wanted. There you go. This reddish one here, that's the GOVT. This is the original one I had. This green one's the IEF. That's the 7 to 10 year. The blue one is the one I'm using, the GOVI, so it's more volatile. Then the yellow gets even more volatile, gets down here, TLH, this is 10 to 20 year bonds. And the purple one here is the TLT, this is 20 plus year bonds. So you see the trend is overall the same, but the shorter the duration, the less volatility in it. So if I look at it on a 1 year, like I said, this teal line is damn near flat compared to all the other ones. And then as you start going further out on the yield curve, things will get more volatile. The most volatile being the purple, which is the TLT 20 year. So our blue line here is a little more volatile with the bonds compared to the other bonds, whether it's in a down or up market. But that's okay, right? Because I'm more interested in the equal weighting of the bonds. So each one is put about 3% across the 30-year maturity yield curve. So if I remove these though, and we do the exact same thing, but we do a new price scale. ADI, IDF, TLH, TLT, GOVT. So now if we look it over at a 5-year, it's a lot cleaner, you know, because it doesn't include the price volatility as much, right? Because all these bonds pretty much do the same thing. You know, why does it have all this shit? Oh, I know why, because it did the price scale. So it's not as volatile, it's not as separated, because bonds are going to trade relatively the same, but the further you're out on the curve, the more volatile it's going to be. So 20 year is going to be more volatile than a 1 to 3 year. So I get rid of these ones. I just get rid of all of them. Right, so our GOVI is a little more volatile because it's further out on the curve versus the GOVT, because its maturity curve is like less than 10 years, or this one looks like it's greater than 10 years. That's fine, so I'll have more volatility in it, but because it's equally weighted, that's more of the risk factor I wanted. So let's kind of just want to show a little bit of the difference between the GOVI and the GOVT. You can still see it's a downtrend over 5 years. As I said, bonds have been going down since the beginning of the pandemic. So going back here, you know, pretty much it's all the way down. Still the same, you know, all the way down. Bonds still suck irregardless. But switching to GVOI now, it's equal weighted. You see, based on the holdings here, it's more spread out. It's more diversified, which is ultimately what we want. Same thing with our S&P 500 ETF, as well as our commodities ETF. We want more diversification. So this is across the entire yield curve. So I got a 1 year yield, 2 year, 3 year, 4, 5, 6, 7, 8, 9, 10, all the way to 30. All right, one of each across the whole maturity curve, and it equal weights them about 3% each per asset, or per bond, I should say. That's our bond ETF.